Somewhere right now, a guy is buying something he does not really need, and he is grinning because he just said the magic words to himself. It is a write-off. He thinks he just got that laptop stand for free. He did not even a little. And the real answer to what a write-off does to your money is stranger than the meme makes it look. By the end of this, you will know what actually counts, what quietly gets you flagged, and why writing something off never means somebody else pays for it. Let us fix the myth for good. Quick note first, I am not a tax professional. I am a cartoon in a sparkly dress who got this microphone because the boss needed a face and his real accountant refused to be animated. So take this as a friendly map, not legal advice, and take the sharp turns with a licensed human. Here's the part nobody explains before you owe money. Businesses do not get taxed on everything they earn. They get taxed on what is left after the real costs of running the business come out. That is all a write-off really is. It is a business expense you subtract from your income before the tax gets calculated. You are taxed on a smaller number. Not zero, smaller. So when you spend $100 on a real business cost, you do not get $100 back. You just avoid paying tax on that $100. Depending on your bracket, that might save you $20 or $30. Helpful, but not free. This is the trap. People hear write-off and they hear discount coupon for life. It is not. It is a smaller tax bill on money you already chose to spend. Which brings up the only question that actually matters. Was this an expense for the business, or was it just something you wanted? Because only one of those two counts. The tax people use a simple test for this. They ask if the expense was ordinary and necessary. Ordinary means it is normal for your line of work. Necessary means it actually helped you do that work. A laptop for a person who edits videos all day is ordinary and necessary. A beach vacation you called a team retreat because you took one phone call by the pool is not. Same money, very different outcome. Real quick, if your write-off needs a paragraph of excuses to explain itself, it is not a write-off. It is a purchase wearing a disguise. The jet ski is not research. Sit down. Now the fun part. The write-offs most small business owners actually leave on the table. These are ordinary, they are defensible, and people miss them every single year. First, the home office. If you use one specific part of your home only for work, you can write off the slice of your rent and utilities that matches that space. The rule is that it has to be used just for work. Your couch where you sometimes answer email does not count. Second, driving. If you use a vehicle for the business, the miles you drive for work can be written off. If Tobin takes the pickup truck to a job site, that trip counts. The drive to grab lunch for himself does not. Third, equipment and software. The camera, the computer, the editing programs, the monthly tools you pay for to keep the business running. If the business needs it to function, it usually belongs on the list. Fourth, marketing and your website. The cost of building an online home for your business, running ads, and getting seen is a real expense. In the money world, being invisible is expensive, so paying to be found is ordinary and necessary. Fifth, learning that makes you better at the work you already do. Courses, books, and training tied directly to your business can qualify. The key phrase there is tied directly. A cooking class does not help a bookkeeper. Sixth, people you pay to help. If you hire a contractor, a designer, an editor, or any outside help to do the work of the business, what you pay them is a legitimate cost. Just keep the record of who, what, and how much. None of these are loopholes. They are just the normal costs of doing business, and the system is built to tax you on your profit, not on every dollar that ever touched your account. Now the other side of the coin. Because for every real write-off, there is a way people get themselves into trouble. and most of it comes from the same handful of mistakes. Mistake 1 is mixing personal and business money. When everything runs through one account, you cannot prove what was for work and what was for fun. And if you cannot prove it when they ask, it does not count. Mistake 2 is the everything is a write-off fantasy. Your whole apartment is not an office. Your personal phone is not 100% business. When you claim all of something that is really part personal, you are painting a target on your own back. Mistake 3 is meals. Business meals can count, but only when there is a real business reason and you keep the details. Who you met, why, and what you spent. Feeding only yourself on a normal day is just lunch. Mistake 4 is the hobby line. If your business loses money year after year and never really tries to earn a profit, the tax people can decide it is a hobby, not a business. And hobbies do not get the same write-offs. Intent to make money matters. And mistake 5, the big one, is having no records. You can be 100% honest and still lose the write-off simply because you cannot show the receipt. In this world, if it is not written down, it basically did not happen. So let us talk about the boring habit that quietly protects everything we just covered. Record keeping. I know, stay with me. This is the part that separates confidence from panic in tax season. Step 1. Give the business its own bank account and its own card. The moment business money and personal money live in separate places, half of your proof builds itself. Every business charge is already sorted. Step 2. Capture the receipt in the moment. Snap a photo, save the invoice, note what it was for. Paper fades and inboxes get messy, so a quick habit today saves a nightmare later. Step 3. Use a simple tracking tool. It does not have to be fancy. It just has to be consistent. A basic system you actually use beats a perfect system you ignore. Do this, and tax season stops being a treasure hunt through a junk drawer. It becomes a quiet afternoon of clicking a folder you already built. That calm is the whole reward. If your future self just relaxed a little, do that self one more favor and hit subscribe. Think of it as a free deposit into an account that only pays out in smarter money moves. The interest is fantastic, and I never charge a fee. So back to our guy at the start, card in hand, about to buy the thing and call it free. Watch what changes when he actually understands the game. He stops. He asks the only 2 questions that matter. Is this ordinary for my work? Is this necessary for my work? And if the honest answer is no, he does not pretend otherwise. A write-off was never free money. It was a small discount for spending you were already going to do to grow. Understand that, keep your records clean, and the tax system stops feeling like a trap and starts feeling like a set of rules you finally know how to play. The guy who buys things to feel rich stays broke and calls it a write-off. The one who spends on purpose and tracks every dollar gets to keep more of what he earns. Same words, completely different life. That is the write-off game, minus the myths and minus the audit surprises. And if you want to run your own numbers instead of guessing, check out the ebooks and the financial calculators over at Jet Set Wealth Style. The links are below, no jet ski required. I promise the calculators are far more fun than they sound. See you in the next one.